Okay, guys. Right. So this is question 16 to 20. I'm sure you've read through this already. They own a large amount of non-current assets. So this is again to do with interest. This is a good question because it allows us to look at how we deal a lot with these interest issues. And this is looking at revaluation. We've seen bits of that. So let's do this one first. So I'm going to do it double entry style, just so you can really see what's going on. So it says that, first of all, they take out a 10 million loan. So let's just do that first. Bank loan. So they take out 10 million and 10 million comes out. And we're told the interest is 0.9 over the year. 9%. So that's 0.09. So if you like, that literally comes to 900,000 or 0.9 million over the year. So really what I need to do is divide that, if you like, well, 9%, 10 million, of course, is 0.9. And if I now divide that 0.9 by the 12 months, I will get what this would be per month. And the reason I'm doing this is because, so that's about 75, that's 75,000, right? And that's because a lot is happening. I can only capitalize over the month I'm actually building. So it tells us categorically that you do not. It says here that what you've done is that you only started construction on the 1st of March. You took out a loan on the 1st of Jan. So we have 2 months of interest that we need to pay. So this is interest. Of course, it's 2 months. So 75 first month, January, 75 second month, and of course you have 150,000 here. I mean, this is 10 million, by the way. So the key point, this is month 1 and this is month 2. So this interest here, these first sets of interest can't be capitalized. So these are finance costs as normal. The question here is, and I'll use a different pen color, if we wish to capitalize that interest, we must only do so in the period we're actually trading. So interest that we can capitalize happened from the 1st of March all the way to I think it tells us the 30th of October, I believe, or the 1st of November, which is the 30th of October. So that's March, April, May, June, July, August, September, October, and that takes us to 8 months. So if you have 8 months at 75,000, you have 600,000 that can be capitalized, and you have 600,000 here, the loan. And then we have 2 more months, of course. So we have 2 months here, and then 8 months here. And the final 2 months, of course, month 11 and month 12, 75,000, just going straight through to finance costs. So 150,000 as well, right? This 150 covering these two. Great. Right. So that would all be wonderful. But then what they did was they took some of this money. So they took 2 out of here and put it in an investment sort of trust, and they earn some interest. And it says that 5% per annum. So if you work out 0.05 times 2 million, and then that's 0.1 for the year. And if you divide that by 12, so we have this 0.0083 going on. So 8,300 technically each month is what is earned. So now, first of all, for the first 2 months, you did not do any trading. So it's just pure investment income. There's no problem with borrowing money and lending it out again. If you wish to. You probably would if you have more interest coming in. So you have interest income. So if you like, you have 0.0083 coming in twice, if you like, for the first 2 months, and that's earning interest, if you like, 0.083 twice. That's the investment, isn't it? That this bond thing that you had invested in. But unfortunately, because this money was borrowed for the purposes of construction, for the 2 months, for the 2 remaining months, I believe, because it says here that this was invested from the 1st of January to the 30th of April. You have 2 more months. You cannot recognize the 2 months of construction against investment income. It's a bit like capitalizing. It's like eating your cake and having your cake and eating it. I'm not even sure which way that goes. But you can't capitalize interest and enjoy income at the same time. So you will now have the last 2 months, if you like, where you actually did trade, where you did construct, of March and April, the 0.083, those 2 months, if you like, have to come off the, this should come over here, 0.0083, have to come off the, if you like, the interest that you have been able to capitalize so far. So that's fine. So you can see that those are that's the other 2.0.083 coming on there. So it's grown in value. Of course, your investment would have, but you can imagine how it would have been a bit odd for you to be able to grow your asset here and then keep this interest capitalized. So these would come off this. So what you now have is you have 600,000 less the combination of this, and this is 0.0167, if you like, and that brings you this is really 16,000, roughly 700, and 600,000 minus this brings us to 583,333. So your answer there is for number 18 is D. I've sort of done that, jumped ahead and worked out 18 because that's really the story of this bit over here. So this is question 18 that we're doing. So so that's 18 over there, and that's D. So that's what I've just done. Let's do 16 and 17 in relation to these people, which is not a deficiency of historical costs, which is not. So generally with historical costs, unfortunately, asset values are understated. That is true. Because we're not revaluing them. Profits are overstated. So because you're not revaluing them, they've probably increased in value, and because therefore and because you haven't revalued them, depreciation is quite depressed, still low. So this is true. These are definitely deficiencies. The fact is asset values are understated, profits are overstated. Financial statements do contain a mix, of course, of current and historical, because you have current assets going on and a mixture. Well, less verifiable, no, because we can see what they originally cost. So actually, they're probably a bit more true in terms of we can see the invoices where we actually paid for these things. So the answer is B. B is not a deficiency. It's not. They are actually just as verifiable. This is verifiable. Can we check what they actually were? So the answer is B there. Now, level 1 inputs, so this is about fair value, which is not true. So level 1 is pretty much open market, most reliable. We just go out there. It's like going on to Auto Trader level 1, if you like, Auto Trader. So we can almost trust the information that's out there. There's a market for these goods. So this is true. You don't really need to adjust. You can trust the market here. Level 2, inputs may include quoted prices but not identical in active markets. So we don't have, the markets aren't as open. So you do need some, not specialist knowledge, but if you like, they're kind of more specific markets. So you might need some more information. Or, for example, you might have a business that you might need to go into the bigger markets to get a better P/E ratio, if that makes any sense, or get a better correlation and then judge. Because the business you wish to buy is not unique, but it's not on the stock market, for example. So you're going to the stock market for some information because you have something similar on the stock market, but not quite identical to what you have. So it's still better. And then level 1 says comprise quoted prices in active markets for identical at the reporting date. So we have a lot of information. So this is all true. Level 3, yes, best information, if you like, but we don't have that information, if you like, and so it isn't the most reliable. You almost need to go in there, and these are very unique products, so you would probably have to pay quite a lot of money for this kind of information, but you don't have that information. So really the best information really is the open information that everybody has available to everyone, and that's the level 1 inputs. So the answer here is, because it says which is not true, and yes, although it does include the best information, it isn't pretty much the most reliable because not everyone has access to this information. So the answer here is B. I've just done 18. So let's look at 19. 19, it tells us that what you have here in 19 is a situation where you have a net increase made up of two items that have fallen by 2 million. So what it means is that we have a revaluation of 26 million and 2 million. That's why we have it. So this 2 million hits the income statement straight away. And this is what goes to our revaluation reserve. So we don't, when we revalue that way, if you include two items that have fallen by 2,000. So straight away we hit the 2 million, and we record the 26 million in the straight away in the revaluation reserve. So we have the 26 million in our revaluation reserve, and because it tells us that you have 10 years left, so each year that's 2.6 million. This is the increase, by the way. This is the increase. So because we're allowed, very similar to an earlier question we did, we can transfer 2.6 million from the revaluation reserve to the income statement every single year, which means that the revaluation reserve, starting with 26, will fall by 2.6 every single year. So when you deduct the 2.6 from the 26, you'll be left with 23.4 at the end of the first year. So the answer there is D. Now let's look at this. If the revaluation model is used for vendor properties, all non-current assets must be revalued. That's not true. All properties in that classification, yes, but not non-current assets like machinery. Be very careful. This is a little trick question here. But all properties must be revalued, just not non-current assets. And they must perform a revaluation every year, really, not every 3 years. So both unfortunately, neither statement is correct. Neither statement is correct. So you must really do this up to date. Your evaluation must be up to date, pretty much. Cool, great stuff. So we'll look at 21 and 25 in the next video.